right, we've got Abhilash Narayan now joining us, Senior Investment Strategist-Group Wealth Management at Standard Chartered Bank. Abhilash, great to have you back on the program. Thank you very much for your time. Yields in the US are moving higher, maybe expectedly. But the question is the rally that we've seen in the US, right? It was just developing into a meaningful bear market rally. Is that already behind us? I mean, have we seen the best of it with what we've seen last two sessions in the US? Your sense?
Well, I mean, what we're seeing in US is clearly a tug of war, right? So if you look at the earnings that are coming through in US Q3 earnings season, they have been better than expected. So of the companies that have reported so far, 74% have beaten expectations. So that's obviously been a key positive driver for US equities. But on the other hand, you do get the downward pull from rising bond yields. And if you look at what's happened in the past week or so, you've seen the expectation for the peak or terminal Fed fund rate rise to around 5%. And just about a month back, that was around 4.5%. So we have seen markets pricing in more hawkish policy from the Fed. And that's been one of the key reasons, along with the guidance from Fed speakers, for 10-year Treasury yields moving higher. And higher yields are going to be sort of a headwind towards any upward move in equity markets. So, it's something that we'll have to watch out for, but we don't think that there's much wind in the sails for US equity bear market rally just as yet.
Okay, Abhilash, good morning and happy Diwali to you, by the way, in advance. It's a crackling Diwali out here in Mumbai, at least, after many years, celebrating in full throttle. Greetings of the season to you. Do you think this is the time to be fully invested in India? And if not, perhaps put some more money to work as well because of the kind of outperformance that we're seeing?
Well, happy Diwali to you and all the viewers as well. I think it's an interesting question, right? So when we think about Indian markets, obviously, Indian equities have outperformed global equities on a relative basis, and that's a call that's worked well for us since March this year. But given the outperformance that we've seen in Indian equities, the relative PE ratios or relative valuation of Indian equities compared to global equities and even emerging market equities are starting to look quite expensive. So what we have done in the past month or so is that we've now turned neutral on equities versus bonds, because we think that RBI will hike rates till around 6.5%. So 10-year yields could move to around 7.5 to 7.75% range. But we think that if investors want to put more cash to work, then rebalancing or allocating a bit more towards bonds is looking a lot more attractive to us at the moment.
Hi, Abhilash. Good morning. Abhilash, since the Indian markets are trading fairly expensive, what could help us is if earnings growth don't disappoint. And that seems that the street is, has a bit of a problem with FY24 earnings, because this year we could get through. What's your sense on it? What kind of earnings growth will you be happy with from the Indian markets for FY24 in particular?
Well, if I look at next 12 months, so not exactly FY24, but a similar time frame, we expect earnings growth to still remain in double digits, around 13-14%. So it's still healthy on a relative basis, but obviously it's not as good as what we've seen in the past couple of years. So as you rightly pointed out, earnings growth becomes very, very important going forward, given the valuations. But we do have fair degree of confidence that Indian equities should be able to deliver higher earnings growth compared to global equities. And sectors that we specifically like include the banking sector, infrastructure, as well as consumer staples.
Abhilash, the other bit is what's happening in the UK, right? But this is not a question really about what this means for the UK, but all of the flip-flop. What does it mean for markets broadly? To kind of sharpen that question a bit, especially from a bond market perspective. What's your sense?
Well, yes, we've seen a lot happening in the UK, and we just saw PM Liz Truss resign. Now, if I look at it from a broader market perspective, what it means is that there is going to be a greater degree of uncertainty because the UK needs to elect a new prime minister, and we do have the key fiscal plan announcement scheduled for 31st October. So if you're looking at the broader risk sentiment, if we do see a disappointment there, markets could have a knee-jerk reaction, and we could see a bit of a risk-off move in UK assets, especially, but also for global assets. But see, from a broader picture perspective, it doesn't really matter as much for Asian equities or Asian assets in general, because Asian assets are driven by their own earnings growth and economic growth outlook. I think From a currency perspective, we think that the pound looks a bit overstretched. So pound is close to the levels that it was at when previous Finance Minister Kwarteng had announced the mini budget, which led to a sell-off in UK's assets. So we think that the pound does not reflect the downside risks to UK economy. So we expect it to come down to around 1.10 in the coming few weeks. But yeah, I think from a global market perspective, US or India, it shouldn't matter much beyond the knee-jerk sort of impact.
All right, Abhilash, it's a pleasure. Thank you very much for joining us. It's been great speaking with you, as always. Happy Diwali from all of us here to you, to your team, to your family as well.